Yes.
Great. Okay, welcome everyone to the Accounting Design Project. We're pleased to have Stephannie Larocque from the University of Notre Dame presenting a paper that's joint work with Brian Bratton and Terry Yon. Just a few housekeeping items before we start. I'd like to remind you to mute your audio unless you're making a comment. And if you would be willing to turn on your videos, I think that helps sort of have participation from everyone. We can see facial reactions. For comments, I will use the raise hand function. So if you'd like to make a comment, please raise your hand. And then periodically, I'll sort of call on people in the order that the hands are raised to make comments and ask questions. We're going to give Stephannie the first 5 minutes uninterrupted. And then sort of from there on out, it'll be normal workshop until the last 5 minutes, which will give her sort of a free rein to finish up. And with that, I'll turn it over to Stephannie. Thanks.
All right, great. Thanks, Kurt. Thanks, Young. Thanks to the organizers of the Accounting Design Project. What a great way to have some sense of community, even these pandemic times. So you've heard of my co-authors. They are wonderful to work with. I think at least one of them is on the call right now, and I'm going to talk about the informativeness of unexpected exclusions from street earnings. There we go. So just as a little bit of background, thinking about street and GAAP earnings, there's certainly a lot of evidence that firms report and that investors and analysts focus on non-GAAP earnings a great deal, and increasingly over the years. The business press has talked about this. I've got a cite here from the Wall Street Journal. The SEC has and does focus on it, and the FASB, of course, you know, Russell Goldman having questioned this, which actually I'll come back to the end when I try to tie this back to the Accounting Design Project. So a lot of non-GAAP earnings out there. We want to focus more on the expectation side of things, thinking about expectations coming from analysts, and thinking about exclusions from street earnings and their informativeness. We want to sort of break them down into those exclusions that are both expected or unexpected. Of those unexpected exclusions, are they informative? Do these two types of exclusions help predict future earnings? And then we'll look at meet or beat activity and really kind of dig further into unexpected exclusions. We'll get into a little bit later is that those can be both forecasted exclusions that are misestimated or items that just weren't forecasted altogether, and sort of map that into future earnings. Now, a little background in terms of GAAP, street, and excluded earnings. Many of us are familiar with street earnings. If you worked with, for example, IBIS, you know that IBIS will basically take actual earnings from the company and often adjust it based on what analysts were or weren't forecasting, what they were excluding from earnings. Exclusions, to be specific, total exclusions are the difference between GAAP earnings and street earnings. And then we take those exclusions and break them down into two bits, one being those that are expected, in other words, what analysts forecast for GAAP less what they forecast for street earnings, and those that were unexpected, which of course is the difference between the two. Now, we're not new to do this. Lots of the prior literature in non-GAAP space has focused on total exclusions, kind of at the firm level. Down here at the bottom, Bradshaw et al., Kurt's paper in JAE has looked at unexpected exclusions. And we've got a paper, my same co-authors, where we focus really on the expected exclusions. But really what we're going to do here is build even further on Bradshaw et al. And some of these other papers related to the components of exclusions. Now, just an example, if you consider a firm quarter where analysts are forecasting 99 cents street earnings, 96 cents GAAP earnings, imagine that the firm actually reports 93 cents GAAP earnings, they miss, and street earnings as determined by IBIS is $1.01. Okay, so in total, what's excluded is actual street, pardon me, hold on a second, 93 cents actual GAAP earnings less $1.01 actual street earnings. And then you can break out expected and unexpected exclusions from that. Okay, I also want to point out I kind of hinted at this already, that those unexpected exclusions are kind of a mix of things. There are things that are excluded. Stock compensation would be an example, where analysts exclude them from their forecasts ex ante, but they get it wrong, so they exclude the wrong amount. Well, that ends up being an unexpected exclusion of one type. And then there are other items where ex post, the earnings have come out and it's determined that discontinued items won't be included in street earnings. So those tend to be unforecasted excluded earnings items. And again, I want to get into those two bits a little bit later in the paper. This is just a picture to show you GAAP earnings. You might not be surprised, is often smaller than street earnings, okay? Which is to say the exclusions, the difference between GAAP earnings and street earnings, are often of a negative nature, as in expenses or losses are being excluded. Now, you know, when you say a picture is not to scale, this is actually somewhat to scale. In other words, to show you that exclusions, when you break them out, are partly expected, but a whole lot of them are unexpected, as I've defined it. Okay, and we see that in the data. There's some prior research, or quite a bit of prior research on non-GAAP earnings, and thinking about exclusions, thinking about why exclusions happen, sort of broken it into two pieces. The first, often referred to as kind of the opportunistic reason for doing exclusion, which is to say, let's follow management, let's curry favor, and by the way, let's make earnings look better than they would on a GAAP basis. And then the second basis is more of kind of an informativeness idea, that if we tune out the sort of non-value relevant components, we're going to be at a more informative sort of non-GAAP measure or metric of earnings. We've got a few research questions. I don't know, Kurt, if I have much more time, maybe I'll just start on the first one and then we can start to take questions. The first one really starts with informativeness, okay? And in Kurt's paper in the JIE, there is some evidence that the market reacts in the direction of unexpected exclusions. And I say some evidence, what I really mean is in some partitions, that's what they show. So we take this a little bit more broadly and say, okay, first of all, let's build on that. Our earnings announcements returns associated with those unexpected exclusions. And then let's also look at analyst forecast revisions. That's another way, going back to Easton and Jamuski, another way of saying, you know, are unexpected exclusions informative? If they are, then analysts would also revise in that direction.
I'm just going to remind participants, Stephannie, if you have a comment or question, you can use the raise hand feature, and then I'll call on you at points.
Thanks, Kurt. Appreciate it. I appreciate you minding the chat and the hands. Okay, so I'll just keep going. The second set of research questions is related more to prediction of future earnings, or if you will, earnings persistence. Okay, now just a little background. There's a number of papers that have gone out and said, well, what is excluded from non-GAAP earnings? And there's a variety of items and a variety of papers that'll say, well, special items, restructuring items, some gains, R&D, taxes in a tax-focused paper. So there's kind of a mix there. You know, there's a mix of things that you could argue are persistent, and then things which are not, okay? So we say, and again, focusing on expectations, if we can look at exclusions as both expected and unexpected, do these two components, do either or both of these components provide information about future profitability? And we'll say GAAP earnings, operating earnings, cash flows when we mean profitability. And then for that matter, if we think about trying to predict future earnings, can we build a better model, a better earnings prediction model, when we disaggregate exclusions, when we split them out into expected and unexpected exclusions? Third set of research questions is when we get into more benchmark beating or meet or beat, okay? There are certainly researchers, several, who have looked into meet or beat. And, you know, there has been some assessment of whether exclusions, again, the difference between GAAP and street earnings, you know, is sort of intentional, a way to mislead investors, or, you know, are they just truly, are investors and analysts truly focusing on things that are non-recurring items, okay? So in Kurt's paper, there's this conclusion that benchmark beating is more related to firms that have transitory items as opposed to recurring items. And we're going to come at this a little bit differently. The data we have, we basically say, now let's go into expectations and think about kind of like I have in italics here, are those exclusions forecasted but misestimated? That's my example where they remove stock compensation expense, but they got the wrong number. Okay, they misestimated. Or are they items that are not forecasted at all? And that's my kind of discontinued items example, things that are taken out ex post. So we're looking into meet or beat and sort of when and how that happens. And then we'll think about when it comes to meet or beat and when it comes to these different types of unexpected exclusions, how does that matter in terms of information content? Okay, in terms of predicting future earnings, and for that matter, how the market reacts. Okay, I'll just keep talking until you stop me. So another picture. You've kind of saw this in one of my original slides about how exclusions, as in the difference between GAAP and non-GAAP earnings, has increased over time. Okay, we've seen that before in the literature. And this is a blue line for total exclusions. Here I'm going to add to that line with, again, breaking it out into the two bits. In red, exclusions that are expected, that we can ex ante see from analyst forecasts. And then in green, which is kind of just below the top line, the unexpected exclusions, which is to say those that we don't really know about until after earnings are released. Okay, so there's obviously an upward trend, but it's certainly worth noting, this is my green line, the second one from the top, that those are, really on the increase, just like total exclusions are. Unexpected exclusions are more and more prevalent. If we look in, 2017, we're up above 60% of observations in our sample. So I'll start talking about tests.
Stephannie, I'm going to interrupt your question just to get us started. So looking at this figure, is this, what can we infer about the magnitude of total exclusions? Like how much of total exclusions is related to expected pieces versus unexpected pieces? Is that sort of here, or this is just observations that have at least one part of it?
Yeah, that's a good point. Now this is, I'm just looking to see if I have a slide with magnitude. This is more of the prevalence of it, the existence of those types of exclusions. We have it in the paper. I'm just thinking, I don't know that I have it in the slides. Yeah, so I do not have it in the slides. I can tell you that unexpected exclusions are quite large relative to expected ones. They tend to be more variable. Okay, so if you look, and we have a sort of time series, if you look over the years, this is probably not surprising, but if you go just past the crisis, you get a lot of unexpected exclusions. If you go past sort of the ugly years or around the ugly years, you tend to get a lot more unexpected exclusions, whereas the expected ones have been increasing, but they're not so variable over time. I'm sorry if I didn't directly answer your question. I didn't have a slide together on that. That's
helpful. Young has a question as well.
Yeah, great, thanks.
Stephannie, this is not my area, so I would like to kind of apologize first. So I'm still kind of wondering that why do we want to spend time learning about those exclusions? So in other words, that when we look at this blue and then green line, it seems that it may just capture the increased volatility, idiosyncratic volatility over time. So during this time period, I think their finance and econ papers also show that those public traded firms, idiosyncratic components of their stock returns has increased over time. There's a variety of different explanations, maybe market become more competitive or etc. globalization, but overall there's observation that's somehow their stock returns is more volatile. So I remember you talked about there are two components of these unexpected exclusions. One is just somehow they missed the number, right? And the realized number is just different from the expectation. And that can be just driven by the underlying cash flow is too volatile. It's almost impossible for anyone to predict. And the increasing volatility naturally would create higher likelihood of missing a number, or the number actually will be very different from your ex-ante expectation. The second element would be kind of something potentially most opportunistic or strategic, is that what items I want to exclude in the end. But I think that's also affiliated or associated with volatility, right? If this is something, an unexpected shock that is outside of my control, like COVID-19, I exposed after I look at the number and understand the nature of the event. I would like to exclude that right before the earnings announcement, that potentially that event was not even expected by anybody, including analysts, 10 or 20 days before my earnings announcement. So I want to know kind of like the sources driving the expected and unexpected, especially the unexpected exclusion components, and then help us understand why we want to spend time analyzing this number, even that number is conveniently derived from the database, but that's why do we care? Yeah.
Okay, thank you. I appreciate the question and comments, Young, very much. So I'll start with just what's in unexpected exclusions, and I'll kind of circle back to motivation and why should we care. One might think that these unexpected exclusions are very much related to, one-time items, volatility, idiosyncratics. In fact, what we find, and we do dig into this later in the paper, is that a whole lot of them are misestimates. So, I exclude as an analyst $10 million of stock compensation expense, and actually it's $12 million. And so after the fact, there's an extra $2 million. There's a lot of misestimation that's going on that's kind of getting buried or sucked up into that unexpected number, which granted does include some, some volatility and some one-time items, but there's a fair amount of stuff that's not that's recurring, that's persistent, which is kind of something we're going to show in our tests. Going back to motivation, and I guess I could have started again with talking about one of Kurt's papers, which is the JAE Bradshaw et al. Paper. I think one of the takeaway from that paper is that investors really focus on street earnings. They compare ERCs based on street and based on GAAP, with lots of correction for measurement error. Okay, so a takeaway from that paper would be we know that investors really focus on street earnings, and we're trying to say, yeah, of course, but let's not overlook a whole lot of other earnings that is excluded and in these different pieces that actually, as we'll show you, is quite persistent, is recurring in nature often, and as a result that the market and the analysts and so on react to. So maybe that's something I could have set up front more, but I think that's sort of our why should we care. It actually has, exclusions actually tell us a lot about future earnings, and the market reacts as a result.
Thanks.
Okay, thank you.
Stephannie, we're going to go to a question from Christina Dargenadu.
Oh, okay. I think she's muted.
So a very related question, I believe. I mean, I just mentioned, the case of COVID. Maybe, the case of COVID could provide you with a nice context to, give more texture, more understanding of what you're studying here. I mean, what I'm observing, recently by looking at financial statements is that, lots of, special items, lots of impairments, but, most of them, in my opinion, were just overdue. I mean, and then, COVID wasn't just an excuse for the companies to take this impairment or this write-down or whatever. So would that be these overdue impairments or write-downs kind of expected? I mean, do I get that right or not? I don't know.
Okay, the way we would define expected exclusions is that the analysts kind of knew they were coming and basically included the earnings in their GAAP forecast, but not their street forecast. So let's think about COVID as a great test case, as you point out, although it's beyond our sample period. But there's going to be surprises that come out of COVID in firms' earnings, but there are going to be other things that people say, hey, of course retailers are spending more on hand sanitizer and so on. There's going to be a mix, and that's, I think, what we're trying to show is that these exclusions do represent a mix of things that are, if you want to use that word, surprises, versus things that are just, we knew they were going to be there, but we got the number way wrong. We really misestimated.
Okay. Yeah.
Thank you, though. We could think about using that as sort of an interesting
extend the sample and just really, use that as a, just a case study. I don't know.
Yeah. No, I appreciate it. Thank you very much.
We have a question from Oliver Binns.
Okay. Hey, Stephannie. Just one question here is when I look at that plot, it looks like, these these expected and these unexpected conclusions kind of go in tandem, right? So when they first kind of go up, then they go down during the financial crisis, and then they go up again. So I wonder, I mean, like what is like really the systematic component behind all of this? You know, like how much is just driven by aggregate conditions? And then if it's so much driven by aggregate conditions, then why don't analysts just, why don't investors just add kind of a fudge factor to it, which is kind of, you know, equivalent to the difference that seems to be pretty constant over time in your plot? Is there, then you would have, you know, much smaller differences. Why do you think this is like happening here?
Yeah, I think I see your point. And if I don't answer it the way you're thinking, please say so. So I was thinking about this last night as I was preparing. It's rare for there to be exclusions and not unexpected exclusions. In other words, if things get taken out of earnings, it is rare that analysts saw it coming and had exactly the right number forecast, or that they saw it coming at all. So it's kind of not surprising, maybe this chart isn't helping me, to show that the top line, the blue line, and the second from the top, the green line, are so close together. Now this goes back, I think, to Kurt's point about magnitude. My chart is more about existence of each type of exclusion. It might be better off if I had a chart, excuse me, with magnitude of each. Does that help, or do you have more?
Yeah, no, I mean, like that, like I think that would help a bit here, because when you look at that plot, you're just like, yeah, well, if you always have the same unexpected exclusion on average for all firms, then why does it matter? You know, like then I see your plot and like my immediate conclusion is, well, I'll just add that factor and I'm done, you know? So it's, yeah, I think that plot would help if you could show that there's like some meaningful variation here and that these differences are not always constant as it appears to be in this plot.
Yeah. Now, I'm realizing now that I really wish I'd had another chart, or actually my table 1 panel 2 to show you here, where we would have all the magnitudes lay out, and whereas this you're kind of looking at it and saying, well, they're almost the same thing. Well, they're really not. There's really quite a difference in the magnitude of the total and the unexpected exclusions. So I will move on from this table and start to talk about some tests, unless anyone stops me.
We have a question, Stephanie, from Josh Ronan. Joshua Ronan.
Okay, thank you.
Joshua? We can't hear you. Okay, we'll come back to Joshua. David Winsich has a question.
Hi, Stephanie.
Hi.
Just a quick clarification question for me. So is part of the paper then about the quality of the gap earnings forecasts, right? So that analysts basically, so this is something that is newer, right? So it's mostly they focus the street earnings forecast, and then later on more and more they also provided bottom line gap forecasts, right? So there's a literature on cash flow forecasts that kind of arguments that they simply add to get to cash flow forecast because they do some simple addition of certain things, and they are not real good forecasts. So could the paper be or could that happen also here, that simply the gap forecast is a low quality forecast and it's just provided, I don't know, for whatever reason, and actually the analysts focus basically on street earnings forecasts?
So I'll put a plug out here for Alison Koister's on the, I can see her on the screen. She's got a paper, Channing Koister, which talks about, I believe, the quality of gap forecasts. And there is a question about just what level of quality are the gap forecasts, okay? Which we're using, of course, relative to street forecasts to come up with exclusions. And we do footnote, we do mention the paper, you know, it is, you know, perhaps an issue that analysts don't spend as much time or as much, you know, put as much effort into their gap forecasts as they do into street. But, you know, if they truly don't put as much effort into their gap forecasts, and that's quite believable. I mean, I was an analyst for many years. I could believe that. All the more reason that we're going to see exclusions, and we're going to see things that get missed or misestimated that the market then reacts to, which is what we'll show in our tests.
Okay, so it is also about the quality of
somewhat,
gap earnings,
I mean,
in a way.
Yeah, indirectly, okay. I suppose it is about the quality, but yeah.
Sorry, can you hear me now?
I can, yes.
Yes, I'm sorry. So if unexpected exclusions are both relevant and persistent and potentially recurring over time, are we saying that analysts are not smart enough to realize they're persistent? Are they learning over time? Is there a time trend whereby analysts expect more of the otherwise unexpected exclusions? What's the underlying sort of theory that explains why analysts are missing these unexpected exclusions, even though over time they observe that they are persistent?
I gotcha. I'm just going to jump back about a few slides. So there's talk in the literature about how analysts are following management, how they're either guided by the management comments on the conference call or even guided ex post by what managers say right when they issue their earnings. And then there's also the idea that, yeah, the analysts just miss the boat. They keep missing these recurring persistent items and taking them out of street earnings, which is to say, maybe not ignoring them, but giving them less importance or weight than they should. It's hard to put a pin in exactly what the one thing that is happening. I think it's really a combination of those things. We can't forget the role of management because, of course, the earnings come from management. Managers issue and release non-GAAPs, pro forma earnings, whatever they want to call them. They're allowed to do that, right, under Reg G. The analysts are in the, you want to call it the game, they're in the position of trying to forecast what managers are going to release, both on a GAAP and a non-GAAP basis. So analysts aren't acting in a vacuum. Managers aren't acting in a vacuum. I mean, that's one of Kurt's other papers is how those two things, managers' use of non-GAAP and analysts' use of non-GAAP, overlap quite a bit. Does that help, Joshua? Or
I think it does. Thank you.
Yeah. Thank you for the question.
One more question from Allison Kester.
Yeah.
Hi, Stephanie. How are you?
Hi. Great. Thanks. Nice to see you.
Yeah, thanks for the plug. Novi and I are working hard on that revision. So my comment is a little bit related to what you mentioned. I really appreciate your Appendix B, and I'm looking at it right now because I want to make sure I get the language right. Thinking about forecasted but misestimated versus just unforecasted at all. And so I actually learned a lot from Appendix B, and I liked that kind of analysis because I think that gives us insight into the quality of these forecasts, right? Are you just totally whiffing and not putting any number down or any line item? Or are you saying, oh, I thought it was 10 and it actually turned out to be 11? And that has very different implications in my mind for kind of the quality of these forecasts. So I just want to offer you a compliment, and I hope that you get to present those analyses on the call, because I think that gives us a lot of insight into kind of the quality of all of these different components of the forecast. And I hope you get to those results so we can talk about them.
I'm really glad you brought that up. I want you to know that my co-authors, Brian and Terry, hired a very expensive research analyst who's paid by the University of Notre Dame. And I read a lot of analyst reports. I've also been involved in the analyst research business in the past, but it was really fun to go back and read about just what's happening and what kind of things are being excluded. It's amazing how much stuff gets excluded and how very little is written about it in analyst reports. I mean, they just do it. They just take things out and there's very little explanation, which makes it actually hard to find what is going on. So I appreciate that you like that part of the analysis. Anyways, thank you. We have no more comments right now, Stephannie, so you can go ahead and proceed. Okay, so I think I'll just jump to where I was. Yeah, okay. I was going to talk about the kind of informativeness tests. We'll do both a ERC type test and then an analyst revision test. And so the ERC test is basically your 3-day CAR and no returns on unexpected earnings components, either unexpected GAAP earnings or splitting it into 2 street and exclusions. Okay, and so that's what this table looks like. Again, CAR regressed on unexpected GAAP earnings versus on the 2 pieces. And I suppose if I can come back to Kurt's JAE paper, a takeaway would be, or really is that they state, is that, the market kind of focuses on or prefers street earnings. Look at what happens to unexpected street versus unexpected GAAP earnings in terms of coefficients. It's quite a difference. But I guess we're trying to say we really don't want to ignore this unexcluded bit, unexpected excluded bit, and let's kind of dig further. I'll also put up the analyst revision test in just a moment here, but that will sort of say, how do analysts revise relative to these same pieces? So let's regress revisions by analysts of next quarter earnings, kind of from before to after the previous quarter earnings are released. And here we're going to see that the revisions, this is in GAAP forecast revisions, are associated with unexpected GAAP earnings, but of course more strongly associated with street earnings. And there's this positive coefficient on these unexpected exclusions. Okay, so back to Ayung's question, why should we focus on this? Well, they matter. The something's being missed here. Something's being sort of excluded and maybe ignored or put less weight on, and yet it is flowing into future returns as well as analyst forecasts or forecast revisions. Alrighty, I'll move on a little bit to more of a persistence, unless you want to stop me. No, okay. So let's see. I'm going to first think about, well, what types of things are being excluded, and then I'll talk about predicting earnings. Okay, so let's take exclusions on the left and see how they are associated with various CompuStat items on the right. This has been done in prior literature. So we're doing this in the same way, the difference between being, pardon me, that we have either expected or unexpected exclusions as a dependent variable. Okay, and in some ways, this lends itself well to what Allison brought up, thank you, Allison, which is that we went and did some small sample analysis and found, yeah, in analyst reports, a lot of this stuff is being excluded, okay? Focus here on, if you will, unexpected exclusions, that's kind of in the middle. They are more strongly associated with just about all of these items relative to the expected, the stuff that's kind of ex ante taken out of forecasts. And you'll notice that some of the things I've got in terms of right-hand side variables are, well, very much recurring items like amortization, like R&D expense, some could, stock compensation expense, some would argue restructuring costs. So there's certainly a persistent nature to the things that are being ignored, okay, missed, if you will, which is where they show up in unexpected exclusions. Now, taking this and just kind of collapsing it, we're going to collapse these variables into those that literature thinks are recurring versus non-recurring. I'll show you the same kind of analysis where I guess I really just want to focus on this and this. The unexpected exclusions, I'm kind of worried that I might have out-of-date numbers here, but okay, what I want to show you is that unexpected exclusions are associated with both recurring and non-recurring items, although I feel like my numbers might be off. I apologize if I did that wrong. Okay, well, let me move on.
Stephannie, a question from Ayung again.
Yeah, thank you.
Hi, Stephannie. I really like the same as Allison, that the appendix, and then also like 2 slides before you showed us those earnings line items. Yep. So I just want to kind of run you by this story that it looks like, so think about like we are teaching our student in an FSA classroom. And then very often when my student asks me, Professor, how do I forecast a company's future restructuring cost or amortization expense schedule for an intangible asset that they somehow have patented and are able to actually recognize it? I feel like usually I don't have a good answer to my students because somehow as an outsider, there's always almost no way for me to forecast unless the manager willing to share some details about the nature of the R&D engineers who are actually going to receive the compensation package, conditional on certain milestones actually have accomplished during that period in that project, or some type of the intellectual property the firm owns, and then how they believe that are going to match with future revenue. So all I'm saying is that potentially the exclusion from analysts, just because they are not able to predict, there's such a high information asymmetry that they just don't even have any information to forecast certain managerial discretionary decisions that managers have definitely more discretion and also better information set to decide those numbers. So I don't know whether this helps, is that it sounds that in the past, in the literature, we have mainly focused on those two hypotheses, either underlying environment is very transitory volatile, so that's why they exclude. The other one is managers maybe, or analysts are more opportunistic, but potentially your paper show us a third source of exclusion. It's just outsiders actually have very limited information in order to actually have any meaningful forecast. So they just give up, they just exclude, and not to test those numbers. Wait till the manager to tell them what the number is, or even they forecast the number is not even meaningful, because more likely than not, they are going to misestimate by a lot.
I appreciate the
that
comment.
yeah.
No, it's actually quite helpful. It's a really good way to explain what we find both in large sample and in the small sample digging through analyst reports, which is to say that there's a mess in there, and there's a whole lot of things that are excluded, but that analysts have a really hard time estimating. I mean, stock compensation expense is a great example. There's a whole lot of misestimation of stock compensation expense. Is that surprising? Well, like you said, there's asymmetric information. It's also just difficult to estimate, period. But on the other hand, you have things like, you know, amortization expense being excluded still to this day. So there's a lot of there's a lot of things going on in there. Let's just say that. Thank you for your comments. We'll certainly, that will help us as we revise the paper. Okay, I want to talk a little bit about earnings persistence, unless Kurt wants to stop me. I think I have.
Yep, keep going.
Good on time. Yep. Okay. So classic earnings persistence model says, let's take earnings scaled by assets on the left, and future earnings on the left, and then take sort of current earnings or earnings in pieces on the right. So that's really what we've got here. I show you GAAP earnings as our dependent variable, but we'll do a few other dependent variables. And we'll take on the right either street earnings or street earnings plus all the exclusions, or street earnings plus each of the two types of exclusions, to try to show you that disaggregating, splitting out the types of exclusions, really makes a difference meaningfully in terms of forecasting earnings. So this is sort of back to the, you know, why does this matter? We can do a better job of forecasting earnings, forecasting future GAAP earnings, for example, when we split out different types of exclusions. All right, pardon me. This is kind of our baseline case. Let's just take street earnings on the right and use it to forecast GAAP earnings, okay? And then we say, well, let's take street earnings and all those exclusions. And guess what? This model number 2 does improve upon model number 1 quite significantly. And then let's take, in model number 3, street earnings and each of the two pieces, and see if we can make for a better earnings prediction model. So we can. You'll notice in the coefficients that either total exclusions or each of the two pieces is persistent, is predictive of future earnings. What's quite interesting, I think, in column 3 is just look at the kind of magnitude of the coefficients on street earnings. Let's just call that 0.92 round numbers. Expected exclusions have a bigger coefficient. Okay, so things like stock comp and amortization that are being excluded ex ante are more persistent, as our tests show, than street earnings. It's quite surprising. Now, unexpected exclusions also persist. Obviously, not as much. There's that, you know, volatility and idiosyncraticness, but also really just, you know, different nature of these. But they're still quite recurring. They're still quite persistent, which is why we sort of say they shouldn't be ignored.
A question from Oliver Binns.
Yeah, thank you.
One more question, Stephannie here. So how do you define, for example, amortization and depreciation? What kind of sign goes in here when you create that variable? Do you just take them at like a positive number, or do you have like a negative sign then?
Okay, let me back up just a little bit, because we thought a fair amount about this and tried to be as clear as possible. Hopefully this is clear. We've got everything set up in terms of right-hand side variables so that it is to show its effect on earnings. Okay, so an expense has a negative number put in front of it, whereas a gain would be a positive number. A loss would be a negative number. I guess that's a better way to say that. And so Okay, and then
See,
let's
then,
back up.
I have one question for you. So,
Yeah.
for example, when you think about restructuring charges and things like that, you know, like these one-time items that just by the properties of conservative accounting then actually increase earnings in the future. So there you might also they should also observe then sign flips just conceptually, right? Like, have you thought about this?
Okay, so a couple of things. One is, interestingly, some in the literature would think of restructuring costs as being recurring, and certainly in some companies they do tend to show up a lot, and not just be one-time items. But I do see your point that restructuring costs and perhaps some of these other items can be in and of themselves predictive of future performance of the firm. You know, we've restructured and so things are going to go better, for example. We've thought about that. We do talk a little bit about that in the paper, but that's something we could build on.
I mean, I think maybe, for example, if you have these large restructuring charges, right, or like large impairments, things like that, then I mean, it could be like a bit comforting here to see that kind of things behave as they should behave, because I mean, if you have these large restructuring charges, like it seems unlikely that this would be like a recurring thing, right, to kind of have a little bit of like variation here rather than always kind of having like the same concept.
Yeah, I guess one thing I'll add is sorry if I cut you off there, we do include, as does prior literature, restructuring costs in recurring items. And then we've done a test kind of footnoted that says when we look at recurring items, sort of autoregressive tests versus non-recurring items, they are in fact more persistent. That does show up in the data. I don't know if this is quite what you're getting at, but or hinting at rather, but I mean, it's worth pointing out that this is a test of association. What are the exclusions? What are the items in CompuStat? Are they associated, and how associated are they in some cases? It's really hard in a large sample to say exactly which analysts, it's almost impossible, exactly which analysts are you know, excluding restructuring charges for which companies. So we can say that the restructuring charge existed in the company. We can say that the analysts were making exclusions, and we can, by association, say that on average, it seems those two things go hand in hand. But it's very, very difficult to say, you know, in this company at this time, is this analyst excluding this type of item?
If you have large restructuring charges, you know, where we really talk about substantial amounts, I mean, that should be like fairly straightforward to measure, no?
It can be measured in CompuStat. The exclusions can be measured in IBIS in terms of the difference between their gap and their street forecast. But the difficulty is, in my opinion, where does the data come from? So IBIS collects data from analysts or the brokers and sometimes from reports. Those reports have very little information in them. And so this goes back to my kind of comment about the small sample analysis we did. You go and look at analyst reports where they make exclusions. A whole lot of the time, they don't even tell you. They just say they've got a street and a gap, or a gap and a non-gap, depending on how they label it. And a lot of the time, and I'm talking like at least half the time, they're not telling you what they're excluding. So to make a really good analysis of that is very difficult, just because the data doesn't, I don't even know that you could get the data. I think you can get it for some analysts.
If you have like a restructuring charge, as you see here, right?
Yeah.
Like, you know, just the incidence of restructuring charge combined with your CompuStat measurement, where you see, okay, this is a really large restructuring charge. I mean, just, you know, putting these pieces of information together, I mean, like it should be like fairly reliably measurable, no?
Yeah, well, and I think that's what we're trying to do here, is to show, yes, restructuring charge, not just yes, but the amount of restructuring charges, not just the incidence in this test, and the amount of the exclusion of either an expected or an unexpected nature. This one is associated with restructuring charges. In other words, analysts do seem to ex ante remove restructuring costs, but ex post, they also actually, you know, take quite a bit out. So quite a bit comes sort of after the fact, ex post, after the earnings surprise.
Yeah, so I think it would be nice if you could use that a bit more, you know, kind of just to give you a bit of sense of whether things make sense, right? So.
Okay, thank you. Thank you. And maybe as I get into the small sample discussion, that might be something we can delve more into. So I'll kind of come back to that if I have time. Kurt, how are we doing? Should I?
I'm gonna let you get a little bit further, and then we can take a couple more questions at that point.
Where was I? I'm right about here. Okay, so we start to get into meet or beat tests, and people in the non-GAAP space before us have certainly looked at meet or beat. I mean, it's a puzzle, and it's certainly, you know, a place where it would seem that exclusions, that ignoring certain earnings items could be used to help firms meet benchmarks. So we focus in first with some descriptive analysis of the firm meeting street but not GAAP forecasts when analysts do and don't forecast exclusions. In other words, when analysts do forecast exclusions, they forecast the exclusions, but they got it wrong. When they don't forecast exclusions, they didn't see it coming. They didn't know that discontinued or write down was coming, and so they missed that. But by the way, that might have resulted in meeting or beating. Okay, so we start with that, and I'll show you that in a moment, and then we'll get back into some of those tests we did before in terms of investor reactions, in terms of earnings persistence, and taking into account both meet or beat behavior and the type of the unexpected exclusion, whether it was a surprise or whether it was a misestimation that the analyst had done. Okay, so somewhat simple descriptive statistics, okay? Trying to think about meet or beat. Let's just step back and think about what do we have here. We have firms for which GAAP and street earnings are different, and for which there are unexpected exclusions. That's, what is that going to be, 51,000 observations, okay? Now, for some of those, I'll start in this second column. Expected exclusions indicator is 1. There were exclusions, they were forecasted, but they got them wrong. Versus this column here, expected exclusions indicator equals 0. There are unexpected exclusions. The analyst did not forecast any exclusions ex ante. They didn't take anything out of their forecast ahead of time. They took it out after the fact. So remember that when they are forecasting exclusions, misestimating them, there's a fair amount of recurring stuff in there. When they're not forecasting exclusions and they're just not estimating them at all, those would seem to be more transitory in nature. And that kind of bears out in the small sample analysis that we did. But anyhow, if we want to kind of compare observations that meet street, not GAAP, again, meet the street forecast, miss the GAAP forecast, and doing that suggests something's happening with exclusions, because that's the difference between street and GAAP. A much bigger proportion of meet street non-GAAP observations are related to, here's my cursor, the misestimation of exclusions. You know, for example, the exclusion of stock-based compensation, but oops, we got the wrong number. The exclusion of some restructuring number, but oops, we got the wrong number. And that is much more associated with meet or beat than over here. This is a bit different from the prior literature, again, based on us having a different way to look at expectations and that the way that analysts are or aren't forecasting exclusions. All right. Hold up there. I'll just move on a little bit further in terms of persistence and maybe an ERC test based on my timing. In taking into account meet or beat and taking into account whether those exclusions were forecasted, misestimated, or unforecasted, kind of ignored until the earnings came out. You can see here the, I basically took coefficients and put them in a chart to make it sort of maybe more visually appealing, but you can see here that the coefficient on unexpected exclusions, remember we already said unexpected exclusions are persistent. They help predict future earnings, but that is the by far the biggest case when they meet street, not GAAP. Okay, so you've got benchmark beating, and when there is misestimation. Stock comp is taken out, but misestimated. Well, guess what? That unexpected stock comp is quite predictive of future earnings. Okay, and this is kind of a 2 by 2, so it's breaking out these different meter beats and whether these were forecasted or unforecasted exclusions. Okay, I don't know if I want to talk about the next one or maybe go more to, maybe talk quickly about this and then go more to the small sample. ERC tests, this is sort of taking into account these two items, meet or beat behavior, as well as what the exclusions forecasted, but misestimated, or unforecasted, kind of missed altogether, okay? And it seems that when they didn't forecast the exclusion, the market is reacting the most. Let me kind of summarize, but I want to hone in on this last point because this is really going to help me get to that small sample analysis. To summarize some of our findings so far, and then I'll talk about the small sample. We're seeing a lot of unexpected exclusions. They're frequent, and not only that, they're quite sizable in magnitude, okay? They are value relevant in the sense that investors react and analysts react in terms of revising their forecasts, probably because they help predict future earnings. They're persistent. They're associated with recurring items, not just non-recurring items, as one might expect of unexpected exclusions. Now, what's sort of different here is that we do take these unexpected exclusions and break them into misestimated excluded items and unforecasted excluded items. If I can kind of hone in a little bit more on what's in our small sample, kind of grabbing for some slides here for just a sec. Yeah, to Allison's point, I didn't really summarize them, but I think what we want to say is that having looked at subsamples, we've got evidence in terms of what's being misestimated versus what's being ignored altogether, and what's being misestimated. What's being misestimated is certainly, well, it's a function of things like amortization and stock-based compensation, recurring items that are getting taken out, but not in the right amount. And so this is kind of adding to this unexpected exclusion puzzle. As opposed to unforecasted excluded items, there's a whole lot of different stuff in there. There's a whole lot of, there's gains, there's losses, there's all kinds of stuff. One-time write-downs and so on. Okay, I want to
go to Allison for a quick question.
Yeah, please, thank you, Allison.
So I just really like the small sample because you can really get down and have, Novi and I have read a bunch of these reports too, and you want to know what is actually being excluded and then the exact amount of the line item and then why, right? And no one really gets into the why in these reports, which is the really interesting piece. Yep. So in your small sample analysis, you can dig really deep into, in your example, stock comp, I estimated 10, it's actually 12. But in the large sample, I think all you can really say is that the analyst did not forecast anything versus the analyst forecasted something, but it was the right amount. So you don't know how many of those somethings that the analyst forecasted in the large sample, right?
How many of those somethings? Like there's one big number which might encompass several types of exclusions.
Exactly, right? Yeah. So the analyst could have gotten a particular adjustment right. This thing was 10, I estimated 10, but then they could have completely whiffed on all of these other items. They could have said 0, they could have said a billion. And you don't know any of that in the large sample stuff. Is that correct?
Oh, agreed. I mean, in a large sample, it's very difficult, if not impossible, to know what exclusions encompass.
Right. So I was more just thinking about the language which you describe all like the table 6 test. They forecasted something, but they got the number wrong, but it doesn't really tell you like the quality of the forecast. It just tells you that they put forth some level of effort, but you have no idea what it's about, right? Yeah. Versus like no effort at all when we're saying gap equals street, the expected exclusions is going to be 0. So it's more just kind of writing up like what we can learn from table 6.
Yeah, so we try to be careful in terms of how we describe exclusions and what is being excluded, to admit that we can't completely identify, we can associate, but I take your point, we can go back and write that better. You can always write papers better, right?
Empathetic reader, I completely understand.
Yeah, you know, it's interesting just because you brought it up in terms of how many items are excluded. We don't really get into this, but I can tell you, having read through a whole lot of analyst reports, there's not a ton. I mean, in an analyst report, there might be one type of item excluded. There might be 5 or 6 different earnings items, rarely. It's usually lumps, and I would suggest it would be between 1 and 3 different items most of the time. And that's just kind of based on my memory, but I could go back and check just how many things I ticked off. I kind of had a Excel spreadsheet going. Anyhow,
We're going to give you the last 5 minutes, Stephannie. Correct as you will.
Thank you. So I talked about my findings, and hopefully I've been somewhat clear about them. Talk a little bit about contributions, then I want to come back to the accounting design project, which is sort of where I started. So there is evidence out there, this is certainly Kurt's JA paper, that the market responds to unexpected exclusions in some partitions, and we're providing evidence that this happens kind of pervasively, that market participants, including investors and analysts, are reacting. Maybe not a surprise, because unexpected exclusions are quite persistent. Okay, they're associated with recurring items, and they do predict future earnings. They help make for a better earnings prediction model. We certainly add, I think, to this literature in terms of breaking out the type of unexpected exclusions, the idea that this kind of been brought up today, that some are misestimations, things that were forecasted and excluded, stock compensation exam, versus things that were missed altogether. Okay, so we add to that, and that helps us understand better, we think, the nature of meet or beat behavior and how it relates to unexpected exclusions. Let me talk, like I said, about the accounting design project, which again, I really am a fan of. I've listened to a whole lot of these workshops and learned a lot. This is sort of most of what I had up on my second slide. I mean, this has been going on for a while. So I will give you a little background. I was an analyst until 2002. I did my PhD, and then I started being an academic in 2009. So I kind of wear both hats sometimes. When I was an analyst up until 2002, non-GAAP reporting and non-GAAP, even the term, was very rare. It's much more prevalent now. And like I said, having read through analyst reports, it's happening all the time. So there's a lot of evidence that not just investors and not just firms, but analysts too, are focusing on non-GAAP measures. It's bigger and bigger than it used to be. The magnitude of the difference between GAAP and non-GAAP is bigger than ever. I moved this up to the top. You know, what Russell Goldman had to say really does have to make one think. And I'm not here to say accounting is bad, and I'm not here to say that GAAP is bad. I don't mean that in any sense. But, you know, investors and analysts do vote with their feet in terms of what they focus on. Sometimes they're wrong. Joshua Aronin, you know, raised that point. Sometimes analysts are excluding things that they probably shouldn't because they're persistent. But one does have to ask, you know, just why is GAAP here, and sometimes the market or the analysts and the firms, for that matter, are over here. Some of it's misleading. Okay, prior literature has argued that. Some of it is perhaps more informative in terms of using a non-GAAP measure than not. But one really just have to think, and I'm not here to provide answers. I just want to sort of throw that out here. You know, for those who want to think about the design of accounting, why is all this non-GAAP going on when we've got a perfectly good set of standards? So I'll leave it at that. Interested in any thoughts anybody has. Before you add those thoughts, I'll just mention to plug for Sarah Toynbee, who's going to be up in 2 weeks doing her presentation, and on the bottom of the slide it mentions the topics, so I won't read that out. But if anyone wants to talk about sort of accounting or a little bit more about the paper, please, I'm here for a few more minutes. Thank you.
We'll take any more questions in the last couple minutes we have, and thank you to Stephannie for presenting her paper.
Thank you, Kurt. I'm going to